Okay, let's dive right into this explainer. Today, we're taking the high-flying public safety tech giant Axon Enterprise and running it through our ultimate valuation gauntlet. As an expert investment analyst, it's my job to cut through all the market noise, look right past the hype, and systematically figure out what this business is actually worth. Here is the game plan for the gauntlet. First, we'll get a quick company snapshot. Then, we'll test the stock through the legendary lenses of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll run a modern DCF and look at some comparables before wrapping it all up with our final synthesis and verdict. Section 1. The company snapshot. Because, you really can't value a business if you don't grasp its sheer scale and current market momentum. And Axon is absolutely dominant. They build the tech ecosystem for modern law enforcement. We're talking tasers, body cameras, and massive cloud-based evidence management software. We're looking at a beast of a company with a $41 billion market cap and a share price that's been floating somewhere between $495 and $746 recently. But here's the kicker. It trades at an eye-watering price-to-earnings ratio of over 198 times trailing earnings. So the big question we have to answer is this an unstoppable compounder or a dangerously overpriced bubble? Section 2. The Buffett lens. First up, let's look at Axon through the eyes of the Oracle of Omaha himself, Warren Buffett. Now, what's really fascinating here is that Axon passes Buffett's economic moat test with flying colors. Get this. Thanks to their Axon evidence platform, they hold 40 times the proprietary data of Netflix's entire catalog. That is an incredible, intangible asset that completely locks in their customers. They also have super consistent earnings, boasting 34% year-over-year revenue growth in Q1 2026, and their debt is totally manageable at just a $1 billion net debt position. But they fail his profitability test with a pretty low 6.76% return on equity, and honestly, they completely fail his margin of safety test at the sky-high price. To put that price into perspective, let's look at $450 million. That is Axon's projected 2026 free cash flow, which we use as a proxy for Buffett's famous owner earnings. Now, $450 million is a massive chunk of cash, right? But it is still tiny when you compare it to a $41 billion price tag. For Buffett to get his required margin of safety, even assuming a solid growth curve for those earnings, our model suggests he'd literally wait for the stock to drop to around $100 to $150 just to even consider buying it. Section 3. The Lynch lens. So, if strict value investors like Buffett are out, what would growth guru Peter Lynch think? Lynch would undoubtedly categorize Axon as a fast grower. 9 consecutive quarters of 30% plus revenue growth, that's phenomenal. But Lynch famously wanted growth at a reasonable price. And looking at the data, Axon's next 12 months PEG ratio sits at a lofty 3.7x. That's way above Lynch's ideal 1.0x target. You are paying an absolute premium for every single unit of that growth. Plus, Lynch always liked to buy before Wall Street noticed. But with Axon, the secret is completely out. Institutional ownership is incredibly high. We recently saw 537 institutions adding shares, while 699 actually decreased their positions. Combine that mixed signal with a hefty $1.8 billion in debt versus $731 million in cash, and well, even an aggressive growth investor like Peter Lynch might wince at paying this much. Based on his criteria, we'd probably only see a buy trigger closer to the $180 to $250 range. Section 4. The Graham lens. Okay, let's strip away all the future growth hype entirely and apply the brutal, old-school math of Benjamin Graham. Graham doesn't care about the AI narrative. He cares about hard assets. Axon impressively passes his size and stability checks, but it spectacularly fails the defensive checklist everywhere else. This perfectly highlights the massive disconnect between classic value investing and modern tech multiples. Graham demands a PE under 15 and a price-to-book under 1.5. Axon, they've got a trailing PE of 198, a price-to-book over 11, and they pay absolutely zero dividends. So, out of curiosity, if we calculate Graham's legendary intrinsic value formula, which is the square root of 22.5 times earnings per share times book value per share, using their EPS of $2.57 and a book value of roughly $44.15, what do we actually get? We get $50.52. That is Graham's fair value, meaning Graham wouldn't touch this stock unless it plummeted almost 90%. To get his mandatory margin of safety, he'd demand an entry price way down around $33 a share. It's safe to say traditional value metrics really struggle to comprehend high-margin recurring software models. Section 5. DCF and comparable valuation. This brilliantly illustrates why we have to pivot from those historical gurus to our own discounted cash flow and comparative math. Let's look forward, not backward. To build our DCF, we rely on projected cash flows. Factoring in robust unit growth for tasers and body cameras, we crucially have to account for their software revenue. Software is projected to make up nearly 2/3 of total revenue by 2030. They're currently monetizing around $210 per sensor per month, and there's massive upside there as they push higher-tier AI software packages to police departments. When we use those projected cash flows, which scale aggressively up to over $11 per share by 2028, we can build our base case DCF. Applying a standard 10% discount rate for our weighted average cost of capital and a 3.5% terminal growth rate to reflect perpetual public safety spending, our base case yields a fair value right near $550 per share. But check out this sensitivity matrix. The math actually can justify the current high share price, but only if you assume absolutely flawless execution. If capital gets cheaper and we drop our discount rate to 8% with a 4.5% terminal growth, the value surges past $900. But if capital gets expensive and we use a 12% discount rate, fair value plummets to $380. The current price requires near-perfect future conditions. And let's do a quick reality check against a mature rival. When we compare Axon head-to-head against Motorola's solutions, the picture shifts again. Axon is trading at a massive premium, 198 times earnings compared to Motorola's 32. Plus, Axon is generating less than half the net profit margins of Motorola, at 6.9% versus 17.6%. If Axon were priced closer to Motorola's mature multiples, its fair value would drop dramatically, down to around $110 per share. Section 6. Synthesis and verdict. Okay, we've looked at the past, the future, and the competition. Let's bring all these numbers together. This master summary shows some wildly different views, doesn't it? The strict value investors like Graham and Buffett see a bubble worth under $150. The relative comparables also flag significant overvaluation. However, the modern DCF growth models, which actually price in Axon's incredible software margins and future dominance, show it's fairly valued today right around $550. So weighing all these frameworks, our expert analyst verdict is a hold. Look, it is a phenomenal, deeply entrenched business with an incredible moat and a stunning 34% growth rate. But the risks are very real. You are paying almost 200 times earnings, and they are diluting shareholders with nearly $600 million in stock-based compensation projected for 2026. All the good news and years of flawless future execution are already entirely priced into this stock. There is absolutely zero margin of safety here. Which leaves us with this final thought to ponder as you review your own portfolio. When a company is fundamentally changing the world of public safety, how much is simply too much to pay for a front row seat?